Correct. Variant is necessary but not sufficient to earn excess returns. You also need to be correct more often than not. And equally important, when you are wrong, you need it to not be so detrimental. You need to have that margin of safety that if I'm wrong, I'm not going to lose much, and if I'm right, I'll do okay. So one of the things that I do, and one of the things that sort of distinguishes Aquitaine, I believe, is that we've sort of turned the research process sort of on end. That instead of starting with a company and saying, here's a company that's landed on my desk today. Let's look at the quality of the business. Let's look at the caliber of the management team. Let's look at the valuation, and look at it in sort of in that vacuum. That's not how we approach it. What I tend to do is to say, okay, what situations in the past, and in the past being the last 20 years where I've been doing this professionally, have been associated with situations where there is a wide disparity between the probable truth, the probable outcome, and the current consensus opinion. And so there's a long list that's been developed of these catalyst situations or these bias situations. And so I tend to focus on looking for similar situations first. And then, so if you're looking at companies in bankruptcy or equities as they emerge from bankruptcy, you're looking at spin-offs, you're looking at busted IPOs, situations where we've seen in the past that there has been a broad disparity of belief, and focus on those. That's one thing I think that really distinguishes my research process. And then certainly it's digging deeply to say, well, what are the outcomes here? But more fundamentally than that, it's really a focus on risk control. And so I don't focus as much, and certainly I don't focus first on how much I can make. I focus first, and I focus fundamentally on how can I lose? In what ways could this investment really result in a permanent impairment of capital? In what ways could this sour? And what are the risk factors? Are those risk factors things that are I can get a handle on, that I can have visibility into, that I can research, or is this more of a black box where you're just sort of putting down your bets and hoping that it comes in your favor? There's a big focus on that, and then certainly, if I am wrong, how bad does the downside look? And we are looking for situations where there are highly asymmetric reward to risk profiles, where it is if we win, we'll do very, very well, and if events do not unfold as I forecast, I'm not going to get killed in the name. That is of paramount importance, and that's really the driver. I look at the portfolio as a portfolio of risk, and it's a question of how I put that portfolio together, what risks I'm willing to assume, and at what price I'm willing to assume those risks. And the return, that is something that's less in my control. I get to choose which risks I assume. The outcomes, that is a byproduct of what happens in the market, how events unfold. That's a little bit outside my control.